Let's take a look at some of the historical data associated with these alternatives we've been talking about. First, let me introduce the time period we're looking at. I'm able to take this stuff, these return series back to early 1990. That's essentially the earliest date that some of these alternatives have data. Business development companies may not have existed prior to those dates. For reasons like that, that's about as far back as we can carry the data. And going across the top, the columns we have here are the annual return. This is the historical return over this time period, which is just over 24 years. This is the return they've made. One thing I like to look at is the percentage of time, in this case, the percentage of the number of months here that actually lost money. So here we see what percentage they lost. And just so you can have something to compare with, we put stocks and bonds down here. So here's U.S. stocks. They lost money about 35% of the time historically. So approximately 1/3 of the time the stock market will lose money, 2/3 of the time it goes up. Bonds lost a little bit less, but you can see that the losses on these alternatives are essentially in the same ballpark, if you will, of the loss frequency on stocks. So that's kind of interesting. And then here's the correlation figure we've been talking about. Remember, smaller correlation is better because that means that asset has a better fit in a portfolio. So the highest one on here is real estate at about 60. So that anything 60 or less, let's say, is going to help the portfolio. There's no hard and fast cutoff. 65 would also help, but just not as much. So the other alternatives shown here have fairly low correlations, which is good. You'll see the correlation to the stock market is 1. That's what we mean. The stock market has a perfect correlation to itself, and anything less than 1 is beneficial, but you want to get as low as you can. Managed futures here has a negative correlation of 0.18. Negative is great. If you can make a positive return in the long run and have a negative correlation, that's perfect. Now, 0.18 is pretty close to 0. It's much closer to 0 than -1, which would be perfectly negatively correlated. So I'm going to basically consider managed futures as totally uncorrelated, but not negatively correlated. The rest of these have slight positive correlation, but that's more common. Now, when we look at the returns, it's interesting to note that during this 24-year period, the return on U.S. bonds, about 6.6%, okay? One thing to keep in mind is during the last 24 years, in general, interest rates have been falling. So falling interest rates help bond market returns. Right now rates are pretty darn low, and if the Fed starts tightening as the economy improves, we would not expect future returns on bonds to be anywhere near 6.6%. But this is what they've historically made over the last 24 years. Look at the returns of the alternatives we're talking about here. All but one of these alternatives outperformed bonds during this 24-year period. So of the 9 we've shown here, 8 of them outperform bonds. Okay, let's compare to stocks. On the stock side, 5 of these different alternatives had higher returns than 9.7%, and you'll recall with fairly similar risk characteristics. So that's an attractive diversifier there, especially if you can do that with low correlations. Okay, I showed you before, that was a table of the data. Now here's a more visual way to look at the data. And we call this form a risk-return scatter chart. And so the way to read these charts is on the left we have the rate of return. This is the annual return, again, over the last 24-plus year period, ranging from 0 to 20%. And we have risk, or standard deviation. This is the volatility of the investment on the bottom scale. And so for comparisons, we put the S&P 500, the U.S. stock market here, in the crosshairs. And so you can see that stocks, here's that 9.7%, close to 10% return. And risk is around a little more than 15. So you can now visually see of each one of the alternative strategies how they compare on a risk and return basis to the S&P 500. So these strategies up here above this line, that means they made a higher return than the S&P. and this strategies over here, about 4 of them, made a smaller return. On looking on the risk side, anything to the right of this line of the S&P 500, those are riskier alternatives. And over to the left, these are less risky. So the riskiest alternative strategy on this chart is the business development companies. That's the venture capital type approach that's liquid. And the lowest risk is over here. That's merger arbitrage. On the return side, the highest return we had over the 24-year period is the energy infrastructure. That's the pipeline business. And the lowest return was commodities. But even at that, it's making, you know, a nice 5 3/4% return. So that shows you how these have done over the last 24 years, let's say.